Welcome to VeriScope News. This channel is built on verified facts and clear explanations. We do not rush the story. We do not add emotion. We do not speculate. Our role is to explain what the data shows and how it fits into longer trends. We focus on structure, not noise. Today's report looks at India's trade data for December. Trade data shows how much a country sells to the world and how much it buys. It also shows how goods and services move across borders. All information in this report comes from official government data and Reuters reporting. Every number is explained in context. This is VeriScope News. Verified news, clear context. Every country trades with other countries. They sell goods they produce, they buy goods they need. They also trade services such as software, finance, and transportation. When a country buys more goods than it sells, it runs a trade deficit. When it sells more than it buys, it runs a trade surplus. A trade deficit is not always a sign of trouble. In many cases, it reflects growth. Consumers buy more products, businesses invest in equipment and materials. India is a large and growing economy. It imports oil, electronics, machinery, and industrial inputs. It exports medicines, clothing, machinery, and services. Because of this structure, India often runs a deficit in goods trade. At the same time, it runs a surplus in services. Trade numbers change every month. Shipping schedules shift, prices move, demand changes across regions. This is why economists focus on trends over time, not single months. December data is closely watched. It reflects year-end demand and inventory decisions. It also provides a snapshot of how the year is closing. In December, India's merchandise trade deficit widened slightly. Imports rose faster than exports. Exports remained steady. India's merchandise trade deficit reached $25.04 billion in December. In November, the deficit was $24.53 billion. This means the gap increased slightly. The main driver was higher imports. India imported $63.55 billion worth of goods in December. In November, imports totaled $62.66 billion. Imports include energy, raw materials, and manufactured inputs. These are needed for production and consumption. Exports also increased. India exported $38.81 billion in December. In November, exports were $38.13 billion. Exports grew, but at a slower pace than imports. Exports to the United States remained stable. India shipped $6.89 billion of goods to the U.S. in December. In November, shipments were $6.92 billion. Over the first 9 months of the fiscal year, exports to the U.S. rose 9.75%. Total shipments during that period reached $65.88 billion. Some Indian goods face higher U.S. tariffs. These include textiles, chemicals, and some food items. The tariffs were raised in late August. After an initial adjustment, overall exports stabilized. Services trade continued to support the overall balance. In December, services exports were estimated at $35.50 billion. Services imports were $17.38 billion. This created a services surplus of $18.18 billion. India has run a merchandise trade deficit for many years. This is common for developing and expanding economies. As production grows, imports of energy and machinery increase. Oil imports are a major factor. India imports most of its energy needs. When oil prices rise, import values increase. Capital goods imports are another factor. These include machines used in factories and infrastructure projects. They support future growth. Over the past decade, India's trade deficit has moved with global conditions. Higher oil prices widened the deficit. Lower prices narrowed it. Exports have expanded during this period. India exports more manufactured goods today than in the past. Pharmaceuticals, chemicals, and machinery play a larger role. Services exports have grown even faster. India is a global leader in IT and business services. These exports bring in foreign income with lower transport costs. The services surplus helps balance the goods deficit. The United States is one of India's largest export markets. Trade policy changes can affect specific sectors. Companies often adapt by shifting supply chains or markets. India has also expanded exports to Europe, the Middle East, and Asia. This diversification reduces dependence on any single partner. December data often reflects seasonal patterns. Businesses adjust inventories before year-end. Shipping volumes change around holidays. Economists account for these factors when reading the data. Household finances. Trade data affects households gradually. Higher imports can increase product availability. This can help keep prices stable. If import costs rise, prices may increase over time. This depends on fuel prices and exchange rates. December's data does not show sudden pressure on household budgets. Prices. Imports include fuel and industrial inputs. Fuel prices affect transportation costs. Transportation costs affect food and consumer goods. December's figures do not point to sharp inflation changes. Pressure points remain linked to global energy markets. Jobs and labor. Exports support jobs in manufacturing and services. Stable exports help companies plan production. This supports employment. Some industries face challenges from tariffs. These effects are usually limited to specific products. Companies may shift exports to other regions. This helps protect jobs. Services exports support skilled employment. These jobs tend to be more stable. Savings and investment. Imports are not always negative. Imports of machinery often signal business investment. Businesses prepare for future demand. Stable exports support company earnings. Earnings support savings and reinvestment. December's data suggests ongoing economic activity. Businesses. Businesses monitor trade trends closely. Exporters track demand in key markets. The U.S. remains an important destination. Year-on-year growth suggests continued demand. Importing firms watch shipping and currency costs. Small monthly changes are normal. Diversification across markets reduces risk. Overall, the data shows adjustment, not disruption. What experts are watching next? Economists are watching several indicators. January and February trade data will confirm recent trends. Services exports will remain a key focus. Continued growth would support stability. Trade discussions between India and the United States are also important. Any formal progress could affect future flows. Oil prices remain a major variable. They strongly influence import values. Full fiscal year export totals by March will show whether targets are met. What this means for viewers. For households, December's data suggests stability. There are no signs of sudden economic stress. For workers, export demand remains steady. Services continue to support employment. For businesses, imports reflect ongoing production needs. Exports show resilience. For long-term observers, the message is clear. India's trade position is adjusting within a familiar pattern. Trends over time matter more than single months. Trade deficits are often misunderstood. A trade deficit does not mean a country is losing money. It measures trade flows. Economists also examine the current account. This includes services and income flows. India's services surplus offsets part of the goods deficit. This structure adds resilience. It reduces external pressure during global shifts. Understanding this helps place trade headlines in context. You've been watching VeriScope News. This report focused on verified data and long-term context. No speculation, no urgency. Thank you for watching.